Well, good morning to everyone. My name is Stephen Flynn. I'm a partner with Andersen in Vancouver. Joining me on our special holiday edition of Tax 101 is Krista Rabidoux, one of my partners in Calgary.
Good morning.
So we welcome everyone to what is maybe not always a busy week when we roll up towards the holidays. However, we do know a couple things. One, people are always thinking about tax, and two, a lot of our listeners have always talked about us to say, well, we'd sure like to get professional education or development type credits. And so we'll talk a bit about that. Today's topic is Americans moving to Canada, and it's a difficult one to cover in 50 minutes. We're going to select some highlighted things and some real interesting situations we've seen over time. As always, if you've got questions for us, there should be a box there and you can type in your question. Kenneth Patingo and Min Zhang are two managers with our firm, and they're going to gather the questions, and we'll try and address as many as we can at the end of our session. We've got some polling questions that we'll put out throughout the process here, and that'll enable you to get your CPE or CDE or whatever the educational credits or professional credits that we have. And we know a lot of you towards this time of year trying to make sure that they meet those requirements. So we'll do that. As always, we send out a survey at the end of this, and we get a lot of good feedback and ideas for topics in the future. So please fill out that survey. If you take a few moments, that would really help us for our New Year's webinars. And to the extent you want to actually hear or see what we're going to say, there's a live transcript. You just click the closed captioning button, and that should get you that. So in terms of what we will address today, we'll take a look at the agenda here. We're going to start with just talking about the similarities between the two countries, and Krista can start with that. I'll talk a bit about the differences between the two countries. Then we'll get into some details of things you might want to try and do and plan before you move from the US to Canada, and then some strategy or things that are available to you after you move to Canada. And if we're not done with income taxes, we've got some time at the end. We'll talk about some of the other taxes that impact individuals who move from one country to the other. We'll address those as well. So I'm going to turn it over to Krista. Krista, tell us what's similar between these two countries.
Awesome. Yeah. It's very interesting. A lot of conversations that we have with people, our countries appear similar in so many different fashions. And tax is one of them where we have some similarities. And Steve, as you said, you're going to talk about the differences, which the details are in the differences that generally get people into trouble. But with respect to what are some similarities that exist between the two countries in when you're looking at a taxing situation, both countries tax on a worldwide basis, albeit it's slightly different in that the U.S. tax is based on citizenship or permanent residence. So even if you're not physically present in the United States, you're forever more taxed on worldwide income, sorry. In Canada, if you're living here as a tax resident of Canada, you have to include everything that you earn in the world and do reporting based on that. And so a lot of times when Americans are moving to Canada, that's where you actually have to file the almost identical thing to both countries with some of the differences that exist, but you're reporting your worldwide income to both countries. And so you're almost doubling up your reporting obligation because you're no longer just having to file one return. Both countries have a self-reporting system. And what that means is all tax is basically based on the honor system, if you will, and many laws that exist. So long as you follow the laws and you're doing good, there's no trouble. A lot of the risk that exists is if you don't know what all the rules are and what needs to be reported and you file something incorrectly, that's where you run the risk. And so when we say a self-reporting system, when you're filing your tax return, it's important to know what income needs to be reported, what informational returns need to be done, and any other type of reporting outside of, what goes to the Canadian Revenue Agency and the IRS that might exist. And so when you say self-reporting, often I have people say to me, well, how will they know? And I always tell my clients, don't ask me how they will know. In today's world, information is a lot more readily available. what you want to ask yourself is, what is the risk when they find out? And are you willing to accept some type of risk? And so the world of self-reporting is based on the honor system when you're looking at that tax reporting. Both countries have April filing deadlines. The United States is April 15th if you're a US resident, and in Canada, it's April 30th. Now, once you move to Canada as a US citizen, your deadline actually changes to June 15th under an automatic extension, but both have that initial April 15th, April filing deadline for personal income tax returns. And both countries actually require regular installments. And so what that means is if your tax liability is over a certain threshold in Canada or in the United States, you're required to prepay in your tax throughout the year for what you estimate your liability to be. And it's generally based on the prior year's tax liability to determine whether or not you're going to have to make those quarterly installments. And if you don't make them, the risk is you have penalties and interest that both CRA and the IRS will charge you if you don't make your accurate estimated tax payments down in the US or installment payments up in Canada. Two different terms, but they're identical in what they are in the form of the purpose is to prepay in the tax. The governments don't like to be our savings accounts. So if we don't prepay, then there's that risk of interest and penalties.
And that interest has gotten a lot higher
Yes.
in the last couple of years. I believe Canada Revenue Agency, for example, the late payment interest, I want to say it's approaching 10% per annum.
Canada, that's right. Yeah.
That's right. And there can be additional penalties for underpaying as well. So that's your starting point. That becomes an expensive method of financing. So.
It is a very expensive method of financing. And Canada just massively increased their rates for 2024 to that 10% rate. So I think they found that they were financing a lot of people. So they're trying to make it less favorable to have a loan with them, if you will. Some other similarities that exist is actually our tax rates. The tax rates aren't that much different when you're looking at different jurisdictions. And so a lot of times people, and Steve, you'll go into this a little bit with respect to the differences, they pay less tax in the United States. And historically, the US had allowed a lot more deductions than they do today with the 2017 law changes that exist. Now, some of those are coming back potentially, but you can see here that the rates truly aren't too much different when you're actually comparing high taxing jurisdictions such as California and British Columbia. Their rates sit at a much higher percentage. Whereas if you actually look at Alberta, the top rate in Alberta is 48%. So when you're looking at how much tax you're going to owe, you don't just take into account the rate, because the rate in of itself isn't that much different. Now, obviously, there's varying differences across Canada depending on your province. Like I said, Alberta's at 48%, British Columbia at 53.5%. But then you have somewhere like Florida where there's actually no state tax. So you're going to have a much lower 36% rate down in the United States. So it really depends where an individual's coming from and where they're going to figure out what that differential is going to be in the tax rates that exist.
Yeah, and Krista makes a good point there. When we set up the slides, we were just trying to show a point. I'll go through an example shortly that pinpoints just on that concept of the U.S. has a concept of federal state tax, and there can be wide differences.
That's right, exactly. And I would say Canada, the differences aren't as vast as you see down in the United States from states to state. Canada is, fairly close to each other, the different provinces in Canada with respect to the rates, but there's definitely variations across the country that exist. And so, Steve, do you want to start talking about a bit of the differences that exist?
If we can, yeah, sure. Just go back on that other slide. Sure. The other point there, if you look at the capital gains rates, and this is I always think an interesting example because Texas, which is a state that has no personal income tax, when you compare the capital gains, the top marginal rate, and this is long-term capital gains, so this would be a capital interest in something you've held for longer than a year, you can see the difference between someone, say, working in Houston or Dallas that gets transferred to Calgary or Edmonton. The capital gains tax rates really aren't that much difference. And so even though there's no state tax, you can have these unique results that actually have a very similar rate.
That's right.
If you go to the next slide, then here's where we talk about some of the differences. And while, again, there's a whole host of differences between the two countries, we're going to focus on a couple here. We're going to keep talking about income tax rates, and specifically the starting point when you get into those top marginal income tax rates is very different in Canada compared to the United States. And this is a big reason why Canada's income tax rates in a dollar basis can be so much higher than the United States. And so, for example, starting in 2024, an individual who lives in British Columbia, they hit that top marginal tax rate of 53.5%. The next dollar of income they earn over $241,000. A little bit higher in Alberta, but kind of the same concept that you start to get into the higher tax rates quicker and you reach the top marginal rate a lot sooner. In contrast, if you just look at the federal brackets, as a single individual, you don't hit that top marginal tax rate until you almost have $600,000 of income. And as a married couple, it's almost $700,000 of income. And so while as we showed, some of the rates can be higher in Canada compared to the United States, it's where the brackets break that make it a lot much different. For example, and if you look at the bottom of the slide here, take a married couple and take a situation where one spouse is earning $200,000 Canadian and the other one isn't earning any income. So compare the two liabilities here. If they lived in Washington State, and that's a state that has no income tax at the state level, it has a capital gains tax, but we're just talking about their annual salary. So the total income tax is $24,000. In contrast, for some of the reasons we listed, the fact that the top marginal rates increase quicker, the fact that, as we'll talk about later, you can't file together, that tax is more than double. It's $60,000. And so there's a real big difference when you just go across the border, say from Seattle up to Vancouver. It can make a real big difference. Going over to the next slide, some of the other differences we see, payroll taxes. So someone who's got a salary, someone who's earning self-employment income, they're going to be subject to payroll taxes. And so in Canada, those are things you see. There's Canada pension plan premiums that pay into our government pension plan. It's employment insurance premiums that goes into a fund to cover a situation where you're let go or laid off, or you don't have work, and so you can collect a government fund or a fee, if you will, revenue for paying into this fund. These payroll taxes are mandatory if you're employees. If you're self-employed, they're calculated different ways. In fact, Canada is actually less expensive than the United States. Now, you may not get as much when you retire or when you go to collect, but if you look at Canada's rates, while the rates between the two countries are pretty similar, it's about 7.5%, it's where the maximums kick in that makes a big difference. In Canada, in general terms, there's a cap or a maximum of about $70,000, meaning for every dollar of income you earn over $70,000, you don't pay any Canada pension plan premiums and you don't pay any employment insurance. In contrast, in the United States, that cap is more than double. Or, next year it's $160,000. You're paying 7.65% that as an employee on the first $160,000 of your income. And after that, you're paying Medicare, and there's no limit on Medicare. So you pay 1.4%. It doesn't matter how much you make, you keep paying that. And so the rates are a lot higher in the US. You'll get more when you retire, but I think if you look at the what you get out of what you pay, this is really an income tax. This isn't anything other than a forced savings that yields a pretty minimal return. Go ahead, Krista.
Like I was saying before, when you're comparing the apples, sometimes it's apples to oranges, because you can look at income tax rates as your sole source of comparison between the two countries as to how much after tax or how much cash you have left in your pocket after you're done paying for the differences that exist. And this is a prime example that maybe the tax rate's 1% higher, but then you're paying additional payroll taxes for FICA, Medicare, plus if you have to pay some on your return as well. So there is varying differences that exist.
Absolutely, absolutely.
Yeah.
So take that same married couple I spoke of. One spouse is earning $200,000. The other one isn't earning any income. And we talked about the income tax difference before being so different, meaning the U.S. income tax was so much less than Canada. In contrast, if they stayed in Seattle, if they stayed in Washington State, their payroll taxes are close to $15,000. But if they come a resident of Canada as an employee, those payroll taxes are a third of that. They're about $4,500. And so I think what families have to do when they're analyzing all the different variables that come into what's the impact on us when we move to Canada, you got to take into account the income tax, you got to take into account the payroll taxes as well, in amongst all these other differences, and some of which we'll speak to today. Next slide then. So some other differences we see, unlike the United States that allows a married couple to file a joint tax return, combine their income on the return and achieve some tax savings, Canada doesn't have that. Over the decades, the federal government has explored that. And I think the conclusion has been it's a pretty expensive proposition for us to be able to, it'll be a big revenue loss, if you will, for the government. So, not something that we have here. Each individual files their own Canadian income tax return. And so we'll talk a bit later about some of the planning techniques we use to try and get to a situation where we had before a couple moved to Canada where they could combine their income on one return. So there's no joint tax returns in Canada. A very different treatment of death. So the US has a concept of estate taxes, both at the federal level and in some states at the state level, where there's a calculation based on the fair market value of all the assets you own. Doesn't matter what the cost basis is, doesn't matter what the unrealized gain is. You pay a tax based on whatever that value is. There's exemptions that, kick out most, if not 99% of all Americans, but it's there. In Canada, it's a very different concept. 50 years ago, we had an estate tax. That was abolished sometime in the early 70s, if I remember. And not that I would remember. I've been told that. Canada's got a very different concept. It's what's called capital gains tax. So your unrealized gains when you pass away as a resident of Canada would be subject to tax. You can defer that tax if you're a married couple and if your spouse survives you and inherits your assets. But in general terms, we're not taxing on the value, we're taxing on the unrealized gain. The income tax treaty between the two countries has some provisions that can coordinate the two so that you may not be paying the tax twice. It's not a perfect system, but that's a very big difference between the two countries. The other are some unusual items, and we've selected a few here. The idea here is, in general terms, Canada's income tax rates are higher. And I'm going to pick two of the three here and say, if you look at stock options and lottery winnings, it's actually opposite. Canada's tax rates are actually lower. And so for stock options, if you meet certain requirements, which in general terms means if you're an employee and if you're issued stock options that are not in the money, meaning that the strike price or the grant price is the same as fair market value at the time that the options are issued, then when you go to exercise the options, the tax rate you pay is more like our capital gains rate. It's more like 25, 26%, much less than our top marginal tax rate of 53%. In contrast, for US citizens, for most of stock options that we see, they're just taxed as regular income, and that can be as high as a 37% rate for a US citizen in Canada. So in fact, for stock options, the US tax rate can be higher than the Canadian tax rate. Lottery winnings is a unique one. In the United States, pretty much everything is taxed. So any kind of gambling winnings, any kind of lottery winnings is subject to income tax as if it's ordinary income. In Canada, winnings from a lottery are not subject to income tax. And so, that's something that, we don't, I wouldn't say we see that often, but it is a very big difference. We'll talk a little bit more about limited liability companies later. They're treated very differently between Canada and the United States. And I do have another slide later that'll kind of get into those differences. So we're at the point where we have a polling question, and we can call that one up here. And so based on what we've told you here, and we'll put the polling question up the screen so you can participate, What we want you to do is select the false statement. So you got 4 different choices here, and you have to select the one that is incorrect. And so the first one is Canada does not allow filing extensions, and a filing extension being if I've got a tax return due and I want more time to file. In the United States, you can file an extension. The second question is Canada requires quarterly tax installments. Third question is Canada allows married couples to file jointly if they've been together longer than 5 years. And the fourth question is Canada's payroll taxes are lower than the United States. So you're looking for the false statement here. So 3 of these things are true.
That's a trick question.
Well, I didn't fool our audience because 87% of you got the correct answer, which is married couples can actually never file joint tax returns. And so Canada's system, didn't address this, but Canada doesn't allow filing extensions. And that's a very big difference between Canada and the United States is, we have to file on time here. And oftentimes we get into situations where we don't have perfect information because a US citizen might have investments in limited partnerships or other type of funds that they don't have the final information and won't have it until summer or fall, but we've got to file a tax return by April 30th. And so you get into a situation where you might have to just estimate or do your best job. You may have to fix it later because we just don't allow extensions. So.
Well, that's a valid point on that is Canada's penalty system, unlike the US that has a late payment and a late filing penalty. Canada is slightly different on that front. So you're right. Sometimes we just get into we don't have the K1s because the US doesn't have to file them till later in the year. So
sure.
we're doing our best guesstimate to move forward. But
absolutely.
All right. So moving on here to some things we can do before moving to Canada. So keeping with the theme of similarities and differences, one of the differences in Canada between Canada and the US is how a sale of your principal residence, primary residence is taxed. So in the United States, you're allowed an exemption limit, $250,000 per person. So if you're married filing joint, up to $500,000 of gain can be excluded from tax. Whereas Canada, they don't tax primary residence. Both countries have fairly similar type of rules, although the U.S. is a little more laid out in that you had to have inhabited the home for 2 of the last 5 years, whereas Canada says you have to primarily inhabit the home. So in both countries, you have the potential to possibly exclude some of the gain, and in Canada, all of the gain. And now, before moving to Canada, sometimes people say to us, well, should I sell my house? What should I do with my home? Is one of the biggest questions that we get asked when people are moving across borders. And it's not always necessary. It really depends on what your intention is once you move to Canada. So if your intention is to keep the home in the United States and start to rent it out, and then you're not going to meet that exemption for purposes of the capital gain and excluding part of it, you might want to look at what you do with that property prior to moving to Canada. Now, I always say don't let tax tail wag the dog, because sometimes there might be other reasons you want to keep a property around. But if the sole purpose is you to have no purpose for it anymore, you have to look at to make sure that that U.S. property will continue to meet the definition. Now, you can only have one primary residence at a time in Canada. So although you can claim the exclusion for a U.S. property, if you've purchased a property in Canada and are living in it and that's going to have gains that are building up, if you have both those properties, say in 2024, you can only claim an exclusion from gain for one period of time. And so it's important to think about it in advance. What's your intention? We often talk when people are moving across borders, what's your intention? What's your purpose? What do you plan to do in the future, in order to determine what's the best approach for what to do with different properties that you own. Now, the treaty does offer that protection in the sense that both countries allow the opposite country to allow the exclusions. Compensation. So this one's quite interesting, and we've done a few webinars in the past on remote workers. That if you're a person that is moving to Canada but plan to continue to work for your U.S. employer, you might want to take a look at that. So compensation as an employee is sourced to the place where you're providing the services. So quite often we get asked the question, well, I'm still going to be paid by my U.S. employer. They're just letting me move to Canada, which is fair and well, because legally, as long as you have immigration status in Canada to work, legally you can work for anybody you want to. They don't have to be a Canadian company. But what happens is your income now becomes Canadian source income, and the employer actually becomes subjected to Canadian payroll reporting rules, meaning that they should be setting up a Canadian payroll and withholding and remitting the Canadian payroll taxes. And so this can run into a bit of an issue for both the employer that you're working for, as well as yourself personally, if they don't do it correctly, meaning they continue to issue you a W-2 because you're a U.S. citizen, so they don't think any different, withhold U.S. tax. And now you as an individual have to pay tax to Canada, because under the treaty, that income is actually taxed in Canada because you're performing the services in Canada. So you're going to have a mismatch of money where they've already withheld U.S. money that you need to go to the IRS and ask for a refund from, and you have to pay tax to Canada by April 30th. Or you're going to have penalties. So you'll want to make sure that if you're moving to Canada, but continuing to maintain a relationship with your U.S. employer, that it gets set up properly. There are third parties out there that help with this situation, help employers with this situation, hiring remote workers. But it's definitely something that you need to think about, because you can't merely just stay on your W-2 and pay into the U.S. tax system. Albeit, as I said earlier, you have to report your worldwide income to the United States. Canada gets that first right to tax it, and the U.S. will allow it a tax credit to reduce any liability that you owe to them. So that's something to think about.
Well, and I think we see that from time to times where it just makes sense for the U.S. company to keep someone on a U.S. payroll for, and it could be non-tax reasons, but they're going to be physically working in Canada. They're going to be resident of Canada. One has to recognize the risk of not doing it properly, but the other one is just the cash flow and the higher tax rates. You go back to that example I showed you. If you took that same person, they're making $200,000, and if they never changed on a Canadian payroll, they're paying $24,000 to the IRS. That, as Krista said, you got to get that back at some point. But now you face a $60,000 payment to Canada. So now you got a cash flow problem. But more importantly, if you're not aware of this, your tax rate's more than double than what you might be thinking. So if your thought is just, well, I'm going to stay on U.S. payroll, I'll be taxed in the U.S. Well, that's not how that works. Canada's going to tax you if you're resident of Canada and physically performing the services here.
That's right, exactly. Some other compensation matters: stock options. So if you work for a company that has provided you with stock options are sourced to where the services were provided when you were given the options. So in this instance, if they're options that already exist and you move to Canada, the U.S. will have that first right to tax those stock options. Whereas if you start to perform services in Canada and get tax stock options, then Canada gets that first right. And you'll hear us use that term often, first right, because as I said, both countries you're reporting worldwide income to. So you're just looking at who gets that first tax and then who gets the secondary tax from you, if there is any secondary tax. Now, an interesting one is actually stock awards. And this is sometimes we refer to the big win in our firm when we have clients that are moving across borders. And if it's done right, you can actually really reduce your tax on certain types of income. And this is one of them. Because when you're moving to Canada, and I'll talk about this a bit, is there's a bump up in basis. And what that means is that's a technical term that basically says if you own certain assets that are not Canadian real property, when you move to Canada, Canada allows you to change your fair market value to be whatever it is on the date that you came to Canada. And so stock awards, RSUs, are one of those things that you actually get to say it's an increase. You get to increase your basis in Canada. And then because it's a capital gains are sourced to the country where you live, not to the country of secondary country, I guess, but not the country you're not living in. And so what happens is Canada allows you to increase the basis. The US allows an election. So you have a situation where potentially you're not really owing much tax on an award you get. Now, this is different for every situation, but I mean, this is an opportunity that sometimes you might be able to truly reduce your overall tax liability to both Canada and the US. And there's not very many instances that you can do that, but this is one of those situations that exists. Tax protection and equalization. This goes back to situations, and the employer one is actually probably one of the best examples where we see tax equalizations exist, where they want to keep you on U.S. payroll for whatever reason may be. And then you move to Canada because they said, you know what, I need you to go to Canada to run this company. So you're actually doing it for the company. And now, as Steve talked about, tax rates in Canada are a lot higher. In most instances, you will be paying more tax in Canada. So what the tax equalization does is it says, the employer says to you, okay, Sue, I need you to go down to or up to Canada to run this company for me or do this project for me. I understand that your tax is going to be $40,000 more. So we're going to subsidize, if you will, your additional tax liability. Now this becomes somewhat of a circular calculation because now that subsidy becomes taxable income to you. And reportable by you, and you have to pay tax on that. But what it does is it tries to bring an individual whole, if you will, whole to a situation that because us as a company have asked you to move to another country with a higher tax rate, we will help support you through that so that your tax liability, you're not feeling that tax effect and having less cash in your bank account. And we often see this with intercompany transfers that happen. So that's about it. So I think it's time for another polling question to, oh, no, sorry, I got one more.
There's a few more.
Yeah,
no, there's a few more, yeah.
I got one more to go here. I talked about the gain. So some of the planning ideas that exist is looking at your portfolio to see if there's anything that needs to happen in that. And you'll want to be talking with your investment advisor through that, because there are situations where you may want to liquidate certain stuff. And in some instances, investment advisors may not actually even be able to work with you anymore because you'll no longer be a resident of the United States for purposes of active trading under the trading laws. And so you'll want to have a definite conversation with your advisor on what that looks like when you move to Canada. Pre-move gifts. So Steve alluded to this a little bit earlier in the presentation when he was talking about the differences, because Canada does not allow married filing jointly. So one of the laws that exist in Canada is this idea of attribution, where if Steve and I were a couple, let's say, and I said, you know what, I make a lot of money, Steve, you don't make that much money, so I'm going to give you half of my cash to invest so that the investment income can show up on your return. Canada says, well, no, we don't like that. You have to actually put that on your return, Krista. And so one way that can exist that potentially can help to get around this is doing any gifts prior to coming to Canada. So these attribution laws don't kick into effect, and you can have this splitting of income, if you will, exist between the two spouses on their different returns.
And this is how an American couple can achieve that great concept they have in the joint filing.
Yeah.
They can achieve this by making sure each of them has some level of income that uses the low marginal tax rates.
But the gifts have to be made prior to coming to Canada, because if you do it afterwards, then you're going to kick into the Canadian laws of the throwback to yourself as the giftor. Yeah. Gifts to family. So this is if there's something, you have family that's remaining down in the United States, if you gift it using your lifetime exemption amount that exists, if you gift it prior coming to Canada, then you cannot have that income be taxable in Canada. Now, this is a bigger question than tax, because you're giving away part of your estate and you have to have all of those contemplations that exist, not just what's your tax liability. So that's a bigger discussion that needs to be had. But that is one way to get your income out from being taxed in Canada. We often see that, and down below you'll see 529 plans or other trusts. You often see us talking with people prior to moving to Canada to get those out because of the income tax reporting in Canada. And then I already talked about the cost basis changes, where in Canada you receive that increase in basis. So you'll want to make sure to do that, keep that value in your records, because that is important for future reporting of dispositions. And in the United States, we can elect to change basis down there as well, if it makes sense. We don't always do that, but that is a possibility that can happen on your U.S. reporting as a U.S. citizen. A very common thing down in the U.S. is the revocable living trusts. We generally say they don't serve a purpose once you move to Canada, because now you've got trust reporting in Canada. Canada has rules that every trust, if you have a resident contributor, resident beneficiary, then it's a resident to Canada, and you have to file trust basis returns, even if there's no income to report. It is an informational return that has to be done, reporting all beneficiaries and people involved in it. And so generally, with these revocable living trusts that have been put in place to own property for probate purposes, don't serve much purpose anymore, aside from creating additional administrative burden. And so you really want to contemplate whether or not it makes sense to keep that in existence, or are you going to gift the property somebody and put somebody else in the trust? There's a lot of contemplation that needs to exist, but you as a Canadian resident shouldn't be the trustee and the owner of that trust. Other U.S. trusts are and 529 plans. I talked about the 529 in Canada. Those are considered a trust. So we generally recommend gifting that to somebody down in the U.S. to manage. If that's not possible, try and at least just have one plan for all of your children, not multiple plans for each children, to reduce the administrative burden of that trust reporting in Canada. Or if it's not much money, do you even keep it? So those are kind of the different levels that you would talk about for that. With the Roth IRA, there is an election that needs to be done when you move to Canada, and you cannot contribute once you move to Canada, or the election's null and void. The income will be taxed in Canada if you don't do this election. So this is an important step to do once moving to Canada. And
so we'll talk a bit about the 529 plans and some of the other trusts. It's actually a very tricky prospect to try and give away that plan before you come to Canada. And I'll talk a bit about some of the ways to approach that.
That's right. Awesome. And then the final one is just pension income. Pension income is tax different. The sourcing of it is tax different because it's treated by the treaty where there's withholding tax, and Social Security, for instance, is taxed in the country where you're resident. So there is different sourcing rules as to when you're going to get your pension, and make sure you think about that before moving.
I think one of the biggest things with pensions, whether you're taking income as you move or you're going to in the future, is in general terms, the Canada-US Income Tax Treaty addresses pensions, and quite favorably. And so it lines up Canada's treatment with the US treatment on US pension plans, like an individual retirement account, like a 401k, 408, all these different types of pensions that are already deferred in the US. They'll generally be deferred in Canada as well. And so it's not until you take money out that should be subject to tax. So you don't have to collapse all these US plans before you move. And in fact, you're probably better off just leaving them there, because Canada's going to treat them the same way as the US does.
Well, and quite often you'll have advisors that recommend transferring your US plan into a Canadian RRSP. That can be done, but you have to contemplate the early withdrawal penalty, and you also have to contemplate if you're potentially going to be double taxed because you can't use all the foreign tax credits. So it's not always the right answer to transfer a U.S. pension into a Canadian pension plan, but often a financial advisor in Canada may recommend that you look at transferring it out of the U.S. into their Canadian RRSP plan. So there's an analysis that needs to be done to make sure if that even makes sense. And so our next polling question, Ms. Ba, if you want to pop that up for us. So select the recommended tax strategy before moving to Canada. A, sell all investments, pay all your tax, and avoid Canadian tax. B, collapse the Roth IRA because it's taxable in Canada. C, withdraw all funds from the 401k plan to avoid Canadian tax. Or D, wind up your revocable trust whose sole purpose is to avoid state probate taxes.
Probably one of the more difficult ones here. I hope we gave people enough information in the last 15 minutes to answer this, because it is tricky. I mean, I think it's when you look at kind of the choices you have, you don't have to do a lot of things, but there are some things you should do to try and make your life simple.
That's right. Oh, and everybody listened. Well, most people. That is right. Winding up the revocable living trust if the only purpose is to avoid probate, because that might not be the right answer.
Sure. And I think two things there. One, why would you not have to sell all your investments and pay the tax now? Well, what Canada does is Canada grants an adjusted cost basis when you come to Canada. So your adjusted cost basis of your investments when you come to Canada for Canadian tax purposes is their fair market value. So if these investments have gone up in value,
you're not paying tax.
It's only post-move appreciation that's subject to tax in Canada. So you don't have to sell everything to avoid Canadian tax. You get an automatic adjustment. With the Roth IRA, as long as you make the election in that first year, and the election requires that you don't make any further contribution to the Roth IRA, that election can be tax-free in Canada, or that Roth IRA would be tax-free in Canada. So you don't have to collapse it. It can be tax-free in Canada. And even in situations where you forgot to make the election, you can go back in time as long as you've met certain criteria, and you can actually make the election retroactively. So
yeah, and they're usually favorable with those late elections, so long as you haven't contributed. I haven't really had an issue with them denying a late election previously.
Sure. So. Excellent.
You want to talk about after you've come to Canada a bit?
Sure. So you've come to Canada, and so now what are you facing here that's different? And so one of the investment decisions that we often see are when people have choices to make as to how they invest in Canada. I'll get you to just flip to the next slide there. Oh, I think, no, I'm sorry, go back one. That was my mistake. So if you look at what your investment choices are, one of the things that as a US citizen or a US green card holder that you run into when you're living in Canada is you can invest in funds and you can invest in mutual funds. And to the extent that these funds are invested outside of a Canadian pension plan and they're mutual funds that are organized in Canada, in general terms, those are going to run afoul of some anti-deferral legislation in the US called the Passive Foreign Investment Company Rules, or PFIC rules for short. Mm-hmm. The idea here is the US doesn't want, the Congress has decided for decades now, they don't want US citizens and US taxpayers deferring and avoiding US tax and avoiding any reporting requirements. And so you run into a regime that subjects you to tax at a really high rate, the top marginal rate, regardless. And it subjects you to an interest charge on capital gains and the tax on those gains you might defer over a long period of time. And it has a whole bunch of reporting requirements. And so one has to be really careful when investing in Canadian mutual funds. There are elections you can make under US tax law that can get you out of those rules, if you will. It'll allow you to have, current taxation of those funds, and some of those elections, kind of beyond the time we have here, but it can get more normal tax treatment. You don't really avoid the reporting requirements. And so what we tell people is if that's your investment decision, that's fine, but I'd rather you not make 20 investments of 25 grand each into 20 different mutual funds, because the reporting requirements are going to be onerous and the returns aren't going to compensate you for that. Instead, you may want to look at a couple of funds if that's your choice and see if you can make some of these elections under law.
One area that is, if you really desperately want to invest in mutual funds and you have RRSP limit, RRSP does protect it, so you can play in the funds in your mutual funds or sorry, in your RRSP, and then it's protected from this reporting.
Sure, sure.
Yeah.
So we've got a few minutes left here on this slide. There are other plans you have. I think as a U.S. citizen or a U.S. green card, you have to be really cautious. A registered education savings plan for your children might have some higher tax rate than you expect down the road. People always say, let's avoid tax-free savings account because U.S. citizens. I don't know that I agree with that. I think you can invest in tax-free savings accounts
Yeah.
if it makes sense. There may not be much room if you've just moved from the U.S. to Canada. Those tax-free savings accounts are taxable in the U.S., but that doesn't mean that that wouldn't be a good decision for you. So it's possible. Some people come to Canada and they're not going to be here very long. Canada's got a concept of departure tax, meaning that if you leave Canada, you're subject to a deemed disposition of your assets at their fair market value. And for people who come to Canada as a resident and are staying here less than 60 months, any assets they come to Canada with as long as they've left within 60 months, in general, those assets are not subject to the departure tax. And so stock portfolios, private company interests, those can avoid that tax. And so people always have to be mindful of how long they're here to, perhaps if they're going to try and avoid Canadian tax on a bunch of unrealized gains on assets that they came to Canada with, they should be thinking about either leaving before to avoid that. We talked a bit about trusts, and I recognize this is a really complex subject here. And a lot of these trusts that are formed in the United States can become a resident of Canada if you meet a couple of criteria. If you are the individual who made the contributions to the trust, any contribution to the trust, and as a contributor to that trust, if you become a resident of Canada, that trust in general is going to be a resident of Canada trust. Even though it's formed in the United States, it'll become a resident of Canada, which means it's subject to Canadian tax on an annual basis of any income, of any gains that are in the trust. And as Krista pointed out before, there's a bunch of reporting requirements you have to do each year. And so things like a 529 plan, if you're the contributor, you're not going to be able to avoid that. And we've gone through this before. Gifting that 529 plan to another family member isn't going to avoid it because you were the contributor. If it was your parents or your grandparents that contributed to the 529 plan and they've never been a resident, maybe there's some strategies that can help you avoid Canadian tax. One of the things I list here is something called a granny trust. The idea here is that if a trust was formed somewhere outside of Canada, and you as the US person are the beneficiary of that trust, and if you've never made a contribution to that trust, and if none of the people who've made a contribution to that trust were ever residents of Canada in a certain time frame, then when you come to Canada, so long as you're not in control of that trust, meaning you're not the trustee, it can avoid Canadian income tax on the basis that there's no contributor to the trust and there's no control or no decisions that are made on that trust in Canada. So there are planning techniques to avoid Canadian tax on the income and gains on certain types of trusts that are formed outside Canada, even though the beneficiary is now a resident of Canada.
Mm-hmm. Mm-hmm.
A lot of information there. I can see we're getting on 12 minutes to the hour here. Go to the next slide, please. The only thing I want to talk about here, and I recognize I'm running out of time, is the taxation of U.S. entities in Canada can result in double taxation, and it can be really an unfortunate result. Canada doesn't look at limited liability companies the same way as the U.S. does. We treat them in Canada as corporations, and so the timing of the income is different. The rates of tax can be different. The characterizing is different, and the limits on foreign tax credits. Ownership of LLCs can be problematic. There can be solutions for those. With S corporations, there can be elections and mechanisms under the Canada-U.S. tax treaty to better time the income in Canada to match the United States. So there are some choices there. A lot of U.S. persons will start to set up a business in Canada. They'll try and do the same thing their neighbors do, which is to form Canadian corporations. I got a bunch of abbreviations here, and I apologize for those. Controlled foreign corporations and the global intangible low taxed income. These are anti-deferral rules that Congress has put in to try and currently tax income and gains that are realized inside a non-U.S. corporation that's controlled by a U.S. person. So we got to be mindful and careful of how we use corporations. Some things we'll try and do, again, apologize for the abbreviation, is consider an unlimited liability company, which can escape some of these anti-deferral rules. It's a disregarded entity or a partnership for U.S. tax purposes. And a lot of times an unlimited liability company can make a lot of sense for a U.S. person. So apologize for kind of quickly moving through that. We've got one more polling question. So your question here is, what is the recommended tax strategy after you come to Canada? So should you avoid a tax-free savings account at all costs? And again, this is if you're a U.S. person. Should you purchase hundreds of interest in non-U.S. mutual funds to diversify your portfolio? Should you elect with Canada Revenue Agency to exempt your Roth IRA from Canadian taxation? Or should you withdraw all your funds from your 401k plan to avoid Canadian tax? And then there's some repeats in this, so this might be a little bit easier. So we'll give people a few seconds here to answer this one.
Purchase hundreds of interests in non-U.S. mutual funds.
I think if you're ever doing multiple choice questions, when you see the word avoid and purchase hundreds, is probably an idea that that's not the correct answer.
All right. There we go.
So terrific to hear that over 80% of you said elect to treat your Roth IRA as exempt from Canadian tax. That's terrific. That is the correct answer. We got one final slide here, and I recognize I want to leave some time for questions. So I'm going to make one point here, and that is there are other taxes besides income tax and payroll tax when you come to Canada. One of the fairly new taxes that's in British Columbia is what's called the speculation and vacancy tax. And there are 13 different regions, I think now. That's probably more than that. There are a number of different regions in the province that a homeowner, if they are not using their home as a principal residence or renting it out or fit some other exemption, can be subject to a VC speculation vacancy rate of anywhere from 0.5% to 2% of the fair market value of the home. And so people that own homes in Victoria, in Vancouver, in Kelowna, in a bunch of different places in the surrounding areas, they could be subject to this tax. Why is it important for Americans coming to Canada? In that first year that you come to Canada, if you buy a home and you try and claim the principal residence exemption on the basis that I'm going to move into this home and it's my principal residence, and that's fine. If you didn't live in Canada the prior year, or in the prior year, if your income was more than half of it reported to the US authorities, and more importantly, not subject to tax in Canada, then you run afoul of this exemption. You become what's called an untaxed worldwide earner. You become this concept called a satellite family. And believe it or not, even though you're using it as your principal residence that first year, because BC looks at the prior year, you might be subject to a 2% tax on the assessed value of that home. Doesn't seem fair because it's your principal residence. That's how the law is written. There are a couple of solutions to that. One would be to claim what's called BC speculation and vacancy tax credits on your income going forward. That's part of it. The other is just to manage your timing when you move to Canada to make sure that more than half of your income is subject to Canadian tax, allowing you to claim that BC speculation and vacancy tax exemption for your principal residence in the first year. It's really a first year problem. Years after that, as long as all your income is taxable in Canada, you should be able to use it as your principal residence exemption. It's just something to be mindful of when you move to British Columbia. So,
one thing to keep in mind with that too, these are other taxes, not income taxes. So there's no credits for them anywhere. It's just another additional potential liability that you might have that can't reduce your U.S. liability at all.
Absolutely.
Yeah.
I apologize for rushing through all this. We're really excited. We got so many things we want to talk to people. If you have questions, feel free to reach out to us. Krista, you want to take us to the final piece here?
Yeah, sure. So as Steve said, if you have questions, we're more than happy to talk with you. As he alluded to at the beginning of the survey, please make sure, or webinar, sorry, please make sure you complete our survey for us. We do appreciate the feedback and any other topics that people would like covered in the future. We're here to share knowledge as much as we can. We will stay on the line here for 5 to 10 minutes to ask some questions, and we have Kenneth on the line here, who has been monitoring the questions behind the scenes with me and a couple managers in our group. So Kenneth, are there any questions that came up throughout the webinar that people would like asked?
Krista and Steven, so yes, we have some questions from our participants. So either one of you can answer this question. First question is it advisable for US citizens to contribute to a FHSA or first home savings account?
I can address that. So first home savings account is an initiative from the Canadian federal government to have people put aside money to help buy their first home. I would, from a U.S. perspective, I think that I'm going to say this is probably similar to a tax-free savings account in the sense that any income or gains in that account are going to be taxable in the United States. They're I think, tax-free in Canada. They're going to be taxed in the United States. In Canada, I believe you get a deduction against your income. You wouldn't get the same deduction in the United States. A first home savings account isn't contemplated under the Canada-US income tax treaty, so there wouldn't be any deduction. This is a Canadian tax strategy that can have some advantages in Canada that may not be harmful in the US. The only open question I'd have is a first home savings account considered a trust under US tax law and therefore has a whole bunch of reporting requirements and penalties? I don't think it is, in the sense that the contributor, the trustee, the beneficiary are really all the same person.
Yeah.
So it's no real trust relationship, but that is a real open question that the community's really fought for and debated whether it's a trust or not under U.S. law, and we don't think it is. I haven't really thought about a first home savings account, whether it is or not, but that'd be something I'd want to look at.
Mm-hmm.
Okay, and I think we can accommodate one more question in here.
Sure.
So, are there any different considerations for a Canadian citizen who is a U.S. permanent resident moving back to Canada versus a U.S. citizen moving to Canada?
So I can take that
Sure.
one. So permanent residents and U.S. citizens are treated virtually the same from a perspective of income tax reporting. So if you are a green card holder and continue to hold your green card, even if it's expired, you're actually considered a U.S. Permanent resident and subjected to worldwide reporting so long as you have that card. Now, there are different rules when it comes to exit tax. If you choose to give up your green card, would depend on how long you were down in the United States. If you meet the covered expatriate tax rules. So the answer is, if you have a green card and you're still actively possessing that green card and you're not choosing to treaty tiebreak to Canada, there is no difference in your income tax reporting than if you were a citizen. That's the basic answer.
It's a good question that really should be its own 50-minute webinar, because the nuances of a U.S. green card holder in Canada versus a citizen, they're nuanced, they're complex. We really should consider that next year as its own topic.
Yeah, that's true. Exactly. Do we have one more quick question, or that one was fairly quick? So
there's one quick question in here.
Okay.
I think this can be the last. After moving to Canada, how is the U.S. pension and U.S. Social Security income being treated?
Krista, go ahead.
Yeah, we talked about that very briefly. So U.S. Social Security would not be taxable in the United States, and instead it would be taxable in Canada. And Canada, based on the treaty, will allow the same laws that the U.S. had, where either it's 50% or 85% includable in income, and it'll allow you that deduction so that it's not 100% taxable in Canada. And so that's with respect to Social Security. Other pensions, now those are reportable in both countries based on the laws of what's taxable and not taxable. U.S. will get the first right to tax that pension. However, it will be limited to whatever the treaty rate is, depending on the type of pension. And then Canada gets the second right. So depending on which portion's taxable in Canada, you would pay your regular tax rate and then reduce it by the tax that you paid to the United States. So let's say your rate in Canada is 30% and you paid 15% to Canada or the U.S. US would get their 15%, and then Canada would get that differential of 50%. So you wouldn't pay tax twice. So that about wraps it up. Our next upcoming webinar is a QR code here that you can scan in, that we're going to kick off in the new year with the new Canadian trust reporting rules that are coming into play for the 2023 tax year, and the first obligation coming up in 2024, and that'll be with Philip May and Paula Owen of our team. And so please feel free to register for this upcoming webinar if this is of interest to you. And I want to thank you for taking the time to spend with us today as we go through this in the holiday season. And Steve, thanks for co-hosting with me. I appreciate it as always.
Absolutely.
It's a pleasure.
Hey, thank you all.
everybody.
Happy holidays, and we will see you in the new year, I'm sure.
Take care.